We're not just doing this for money. We're doing it for a load of money.
Welcome to the Money Tree Show, where we bring you high-level multifamily investors as well as industry-leading experts. We tease out the skills they've acquired, the habits, and the mindset they've developed to make them ultra-successful in the real estate space. It is our goal to give you the knowledge you need to either start your multifamily journey or expand your current portfolio. Whether you're an active investor or looking for a passive investment to supplement your income, this is the podcast for you.
Welcome to the Money Tree Show. I'm your host, Matt Damon, here with my co-host, Anthony Vandermeer. How are we doing today, Anthony?
We're doing great, Matt. No complaints. Summer's over. It's going to be even more over by the time this airs, but that's all right. You know, we're heading into fall. It's all good.
Heck yeah. Today we got a great guest. This is actually a friend of mine, Todd Wheatley, formerly of Massachusetts, now living out of New Hampshire. Todd is a real estate investor focusing on fix and flips, condo conversions, buy and hold investments, and he's also an investor-focused agent. Todd, welcome to the show.
Hey guys, thanks so much for having me. It's good to be here, especially now that I'm north of the border in New Hampshire.
That's the dark side. You cross over there. We usually don't talk to you, so you're lucky this time.
Thanks.
Todd, so share with our audience your real estate investing journey. How'd you get into real estate?
Yeah, so first of all, guys, thanks again for having me. It's great to be on with like-minded real estate investors, and especially with the platform that you guys have built. So thanks for doing that. This comes up a lot, right? We have a lot of folks that we come across in the real estate investment space. They ask us how did we get involved in it? Why do we love it so much, right? So I had before I went full-time in real estate, I was in corporate technology in the greater Boston area for about a little over 15 years. Worked for a lot of tech-focused startup companies and mid-sized companies in the greater Boston area. Really did well, had a good, successful career. But after kind of starting and stopping at a few different companies and seeing kind of the cyclical nature of W-2, corporate employment, really wanted to kind of branch out and create a little bit more sufficiency for my wife and I, right? We wanted to, drive our own sources of income, our own sources of revenue, and have a little bit of sovereignty over our financial destiny. And so this would have been back in 2018. My wife and I started exploring some options for buying rental properties. And after, doing the Bigger Pockets thing and listening to every single podcast in the entire world and being as ready as you possibly can be, like so many others, we decided that out-of-state investing would be our first kind of foray. And so we sat down and thought, and the reason we did that was, at the time we said, oh, Boston's so expensive. We were living in Boston at the time. We can't produce cash flow, all these things that I've now since kind of come to not believe. But at the time, just kind of the price points and the complexity of Boston was off-putting to us at the time. And so we sat down together and we said, where in the United States do we have, family, work relationships, some reason to go explore that real estate market and see if it's more conducive for our initial strategy. And so at the time I was traveling to Kentucky and Ohio for work quite a bit. And we landed on Cincinnati after kind of looking at some of the nationwide market studies and rent growth and demographic data and certainly price point. And so we actually got started. We bought two single family houses in the suburbs of Cincinnati. We paid under $100,000 for each one of those houses, bought them conventional financing, 20% down. And that forced us really to learn how to find an investor-focused agent, how to find a property manager, how to find a contractor, a handyman, because you can't get in the car and go fix the things, right? You're at the mercy of a team. And so I'm glad, in hindsight, I'm really glad we did that. I don't necessarily recommend that to everybody getting started, but it did force us to have those conversations and build and really rely on those relationships, which have served us very well, even in our local market. So that's how we got started. Bought a couple houses, gave them to a property manager, probably micromanaged them more than we should have. but really just got a sense of what it meant to be a landlord, what it meant to, take care of properties from a distance. Yeah, so we got started there, and then after about 2 years, we decided we wanted to kind of shift our focus more into the Massachusetts and Greater Boston marketplace. So actually, we were talking earlier, and we'll talk more about Candor Realty, who I've become involved with, and my business partners. But I actually met a couple of my now business partners through Bigger Pockets and through the local kind of investment network. And they helped my wife and I buy. Oh yeah, you have a question?
No, Todd, I love where you're going with this. I just want to interject for a second for our audience
Sure.
here.
Oh yeah.
Here's a piece of Todd. You live in a super expensive market. You did a ton of research in terms of going out and building out your knowledge base by listening to podcasts, by reading books, by going through this. And then you said, "Hey, listen, guys, let's look at buying out of market." That seems like a very scary thing to me. I've never bought out of my market. I've always lived in there, but you took that leap and it got you started. So folks that live in expensive markets, don't let your market dictate what you can do. And the point that I want to make here is, like, you've invested in a market that if you guys lost over there, like if you were to take a loss or to fail, like you fail small, like it's a small step. Whereas today, from knowing you, Todd, I know you're investing in the Boston area, and you're taking massive bets, right? But you built up that skill set over time. So I just wanted to put that point in there because I think it's a really important point for those who are looking to get started.
You nailed it, right? And that's what we recommend to a lot of our clients. We see a lot of folks. I remember being in this position myself. Analysis paralysis. People they've read every book, they've listened to every podcast. The next step is action. You won't progress until you take that that knowledge and put it to action, and whatever that means for you, right? For us, that was taking a smaller bet at a price point in a market that wouldn't have made a huge difference to us. If we bought those houses and totally mismanaged them and the market didn't work with us, it wasn't going to be it would have been a learning kind of education, right? That then gave us the confidence to take these bigger bets. And again, like I mentioned, 2 years in, we said, let's bring this back local. We know the local market super well, and we're ready to take those bigger bets. So that's what we did.
Totally. You almost learned on, it's almost like you almost misplaced or displaced the fear. Instead of the fear of going out of market, you could have been in Boston or like myself in Brooklyn and have the fear of buying $1 million duplex on your first go around. But instead you bought two homes, each for 100. You're putting what, 20K down. And so, I mean, technically you could have walked away, and obviously that wasn't the goal, but there's a lot less fear of getting in, right? If you could walk away and it wouldn't ruin you, right?
100%. We didn't have, you took the words out of my mouth, which is we didn't have the financial fear factor. We had the learning curve fear factor. We were learning what it meant to, work with a property manager and these other folks, but we didn't have to worry about both at the same time. And we didn't have to worry about making a mistake with our team that was necessarily going to be financially ruinous, which, can happen if you take these bigger bets on $1 million properties or $1 million plus properties. That can be a steeper learning curve for some folks. So yeah, we learned one thing at a time. We learned about the process and the people and the team. And then once we were comfortable with that, then we took the financial fear factor and we moved into kind of a larger financial projects. But we had that confidence and that experience from working with the team. So, awesome. In hindsight, I can't recommend it enough. It worked really well for us.
Nice. All right. So you got the knowledge from the Ohio market. You moved back to Boston. What was the next steps from there?
Yeah. So I was, again, we were exploring this rental market, this real estate investing avenue to create new revenue streams for us. Ultimately, I decided W-2 employment was, I had kind of burnt myself out several times at several different employers. And so we saw an exit. My wife and I saw an exit for me in the W-2 marketplace. But before we did that, and we talk about this with many of our clients, like, I know there's aspirations to leave W-2, but go buy as many houses as you can while you have that W-2 employment, because getting a loan is, orders of magnitude easier. So So we ended up, we were looking for the largest multifamily we could possibly find in the greater Boston marketplace. We didn't really care where it was. We just wanted as many units as possible. So 4 units really, so that we could use an FHA or other conventional kind of owner occupied loan, keep our down payment down, add value through, living there and renovations. But this was for us to live in. This was a house hack, as we call it. Get out of these expensive rental markets. We had sold a single family house we'd lived in for many years. And we said, before I leave W2, let's get into a house. Let's drive our living expenses down as low as possible. So we had flexibility and we had comfort around our living expenses such that I wasn't going to leave work and all of a sudden have this huge financial burden over us. So we met the team at Candor Realty, specifically my business partners, Matt and John. They helped us buy a 4-unit property in Waltham, Mass, that had a nice fit. It was I call it the bonus unit. It was clearly a 5-unit. It was configured as a 5-unit, but it was a 4-unit as far as the city was concerned. So we found it. Actually, we ended up going under agreement the week that Massachusetts entered COVID lockdown. So that was April of 2020, March or April of 2020. And I was like, this is either the best thing I've ever done or the worst thing I've ever done. We're going to find out. So we put it under agreement. The team was able to negotiate a great price because of the fear that was in the marketplace. And a lot of folks said, well, why'd you buy a 4-unit that was a 5-unit? And I said, well, because I went down to City Hall and I said, what's it going to take to make this a 5-unit, right? Open book. What's it going to take? And they said, submit a building permit. Tell us what you're going to do. And we'll tell you what you need to do. So we bought it as a 4-unit saying, okay, if this is all it's ever going to be, we paid a fair price. That's okay. We closed on it. We ended up gut renovating the unit that we were going to live in because we only went in this house one time before we bought it. And my wife didn't even go in the house because, again, COVID, people couldn't let us in. So I was in this building for like 15 minutes before we made a $1.25 million offer on the house. We closed on it. I walked the unit that we had negotiated to be delivered vacant for us to live in. And I said, oh my God, my wife cannot come in here. This is disgusting. So we immediately gut renovated that unit, made it, beautiful, obviously. And then just to kind of put a bow on this, we went down to City Hall and I said, okay, I just bought it. There's clearly a 5th unit, 2 egresses. It's already plumbed. It already has a bathroom. It's plumbed for a kitchen. He said, and we had a building permit within 2 weeks of closing on that property. We added the kitchen, renovated that 5th unit, and ultimately refinanced it as a 5-unit commercial building about a year later. So it was a home run. It was a home run deal for us. Started off as a house hack, and it ended up being it's one of our cornerstone properties even now.
Nice. And Todd, you kept that property, yeah?
We still have it. Yep.
Yeah, that's fantastic. So a couple things there. First of all, one of the things that you were able to do with this house hack is take away your biggest expense. Typically, your biggest expense is housing, right? And so now that's no longer a concern. Think about what that is, audience. If you have, if you're paying $3,000 a month for your house or something like that, imagine that being gone. How much savings is that? Almost $40K a year. That's huge. So kudos to you, Todd. Great job with the house hack. It probably wasn't the ideal dream scenario to live with 4 other units, but you made it happen for a short period of time and you were able to get into that house of your dreams now, which I think is fantastic. So Todd, tell the audience there was a couple of questions. Anthony and I were chatting. There was a couple of questions that we had. Start with going. What's the difference between a 4 versus a 5 unit in terms of the financials? And what does that mean for audience that may be interested in getting into a multifamily situation? Sure.
So as I mentioned, we were looking for a property for me and my family to live in. And so, I'll try to explain this as quickly as I can, which is, as far as lenders are concerned and loans are concerned, single families and multifamilies between 2 and 4 units are considered residential properties. So a 4-unit is no different than a 2-unit or a single family from a lender's perspective. Once you get into a 5-unit property or larger, it's considered commercial. And so that means a whole bunch of things change. Typically you can't live in one of those properties. Typically, it's a much larger down payment. You no longer have things like an FHA loan or ultra low down payment loans. You have to buy them in LLC. So there's a whole bunch of things that get more complicated. There's benefits to it, obviously, but and we'll get into that. But for us, who is looking for a place to live and occupy for as little amount of money down as possible, we wanted to use an FHA loan, but we wanted to buy as big of a house as possible using that FHA loan. So that's why this 4-unit property with this potential to turn it into 5 was about as big of a property as we possibly could have bought with 6 or 7% down.
And out of curiosity, when it went from the 4-unit to the 5-unit, you were able to keep that. I mean, this is not going to happen too often, but it's a very interesting situation. Were you able to keep that FHA loan on the property?
We were. So this is very much an edge case. So I don't really want, I don't want to misconstrue that this is like something that people can go out and just do. It was very much happenstance, but we saw the opportunity in front of us and we took it. So short answer was yes. Once we realized we could turn it into a 5-unit property, and we did so within, the guidelines of the municipality, we created the unit, we renovated the unit, we put a renter in. We had a discussion with council about what we were doing, our attorney, and everything was in bounds. We weren't, necessarily being disingenuous or anything like that. But what our plan was is, we put a lot of work into the house, including the unit we lived in, including this 5th unit. So the intention was put a low down payment down using an FHA loan, build a lot of equity in the house through renovation and adding the 5th unit, and then refinance out of that FHA loan. And because we were now in a 5-unit property, we refinanced into a commercial loan. The interesting thing is we put just under 7% down on the house when we bought it. And just a year and less than a year and a half later, we refinanced into a commercial loan and had more than 20% equity because of all the work we had done. So we refinanced it and didn't have to put any additional money down at the refinance, which was, a really compelling story in a short period of. We created a lot of equity and a lot of value in a really, really short period of time.
That's amazing. And I think what a lot of people, why would you go, why, even if it was I have a 4-unit that's in a commercial loan, that's a commercial property. And people say, why would you do that? You're no longer getting that 30-year loan. I like the commercial loans, even on a 4-unit, because it protects you. Now the 4-unit and your 5-unit is in an LLC. And for me, I'd rather have that protection than have that additional, the longer loan. So for you with that loan, like a lot of commercials, they reset every 5 years. Did you have to roll into one of those?
Yeah, it's a 10-year fixed rate loan, 30-year amortization. And at the time, we didn't know this at the time, but when we did refinance it, we were refinanced at about 4.2% on a commercial loan, which is now looking, pretty great. So our timing, it's better to be lucky than good sometimes. And our timing was great. And I don't have to worry about this particular debt for quite a while. And to your point, Anthony, we run our properties like a business, whether they're my wife and I's personal properties, or whether they're, some of our larger syndication projects. We run all of them as businesses, because that's that's what they are. And so we like the commercial debt. We like the flexibility of commercial lenders. We obviously there is benefit to residential loans and residential insurance when you do live there. But once you move out and get to scale, that commercial flexibility is really nice.
Nice. And then I assume you moved out of this property, then you rented that, did you move into another 4-unit or something similar? Or did you go back to single family and then kept your real estate journey going forward?
We kept the real estate journey going forward. Interesting. Matt knows this story because this is how Matt and I really got first connected. So my wife and I moved into this house, did a lot of work to it, lived in it. COVID started, right? So we bought the house basically when COVID started. We lived in it. We were basically, me at the time, it was 2 small children and a dog living in an apartment building. And we had enough being stuck in this apartment building during COVID. So I said to my wife, well, what's our unit worth right now? Like, what could we rent this unit for? We got renovated it. It's 3 bedrooms, et cetera. And so we reached out to like local housing authority, looked at Zillow, et cetera. And we basically said, this thing can rent for like $3,400 a month, just that unit. So I said, you want to move to Florida for a year or like 6 months or a year? She's like, you're crazy. And I said, well, what if we can rent a house or an apartment or something for $3,400 a month down there. Like that's what the opportunity cost of our apartment is right now. She's like, what are you talking about? So after some discussions and drinks, we basically said, let's move to West Palm Beach. My brother lives down there. We rented our apartment in November of 2021. And we left that last week in November, and we went into our rental in West Palm Beach for December 1st for essentially the same price that we rented our Waltham apartment. So we were down in sunny West Palm Beach, Florida, all winter long, while we rented our Waltham apartment for essentially the same price. So,
folks, we hear a lot about financial freedom, but we don't hear enough about geographic freedom and time freedom. And those are hugely important pieces of living a free life, a life that's free to kind of do what you want to do. And Todd, your story was so inspiring that, many people know this, but you inspired my family to take a trip to Barbados for 6 weeks, because I was like, wait a second, if Todd can do that, a guy in his early 30s can figure out how to take his family with their 3 kids and go travel somewhere nice during a really not so great time, the winter, right? During COVID, and go somewhere really exciting and fun. I can do that. And so can you, listeners. You can figure out a way to do this. And Todd, really, I think your story here is just incredible.
Yeah, thanks, Matt. It wasn't easy. It's certainly not easy with the family, but nothing good in life is. And we really strive to, as you and I have talked about before, we really strive to buy assets, houses and other assets that offer that flexibility, right? Not just spend money, but how do we buy assets that then generate cash flow or other cash offshoots to allow us to go do those types of things. And now we've kind of gone full circle, right? We went to Florida for a winter, we've come back, we've settled into our new home, and that's what we wanted to do. But having that flexibility is really what it's all about.
I rarely get envy, but every time I have a guest on who moves somewhere warm during the winter, that's always when the envy really, really kicks in,
It wasn't so bad. It wasn't so bad. So,
do you think that is there a possibility you might do that again? Is that in the cards or?
Yeah, it's actually part of our, again, it's I think a lot of folks think like, oh, that's vacation, and that's not the way we think about it. We think about it as again, our life, the work-life balance, but also we look at I tend to look at a lot of things through the business lens. So when I came back from Florida, I said, how do I make this happen? Right? We have school-age children. I can't be schlepping them all around the country whenever I want. But I said, how can I build my business, over 2 or 3 year time horizon that I can be down here when I want to be? And so one of the things we're doing is, my team currently is an investment focused sales team in Mass and New Hampshire. I'm nearly licensed in Florida, and we're actually going to start a branch of our team in Southern Florida. And then that will allow me to travel back and forth, go down whenever I want, have a team down there, have business relationships down there, and get down there when I want for the flexibility. Treat those as business expenses, right? But I want to think about this holistically, and not just I want to go vacation in Florida every winter, but how can I build that into my lifestyle and have that flexibility that is not creating a burden, but adding value to my life.
And you're going into a growth market, right? Like it's another great market, Boston and Florida. I'd love to sidebar from your story for a minute. And I mean, so now you're an investment focused broker. Obviously, when you found that 4/5 unit, you were looking for an investment focused broker. Give us some tips that listeners can find. Because to be honest, my first few deals I did, it was, they were smaller deals, and it wasn't an investment. It was just a regular residential broker that didn't fully get it. And so it was only a single deal. How do you get someone to, what's a good way to figure out a broker that is really investment focused and not just saying they're investment focused?
Yeah, I think personally, I feel like somebody who's investing themselves, right? We pride ourselves on that. Big time, the whole team. We actually, one of the things that John, the owner of Candor Realty, and my investment partner strives to encourage in the team is, if you're going to join our team, you need to either own investment property or strive to own investment property within 12 months. That could be an Airbnb, that can be a long-term rental, that can be a house hack, that can be a flip. It doesn't matter. We don't care. But we feel strongly that we can bring the most value to this niche within real estate. Like, we don't sell a lot of condos. We don't sell a lot of single family houses. We do a lot of multifamily. We do a lot of distressed property. And as you guys know, those properties have very unique challenges that most residential agents don't know. And that's not because they're not knowledgeable. It's just a different beast. It's for the same reason that I don't fully understand a turnkey end user single family house. That's not really what we do most of, but we know how to deal with difficult tenant situations. We know how to deal with multiple utility situations, or the things that are unique to multifamily, the different loan types, things like that. So I would look for somebody that walks the walk for sure.
Totally. I 100% second that. When we made our first purchase, our first investment property purchase, we used a regular residential agent, and we got so lucky. There was a rule in the particular area that I was investing. It was in Fitchburg, Massachusetts. I grew up in the city, or lived in the city, and so I was used to not having places that don't have parking, right? But Todd, as soon as they say no parking in Fitchburg, you know exactly where I'm going, right? Because you're an investor agent. There's certain rules in certain areas around what's allowed and what's not allowed. And you can lose your shirt if you're investing with someone who doesn't know what they're doing. They say, oh, it's just real estate. I know real estate. No. It's much more complex than that. You're absolutely right that a lot of residential agents don't understand what some of the investor agents recognize. We're looking at things from a different angle, different lens. And certainly when you're teamed up with a brokerage that is full of investor agents, there must be some level of communication that says, hey, listen, watch out for that. Think about this.
Yes.
Go for that. Because you guys are a big team and you guys do a lot of transactions. And I know both yourself and John and other people in your group have bought hundreds of units in some of these areas. And so you know it better than most residential agents. So I think that's spot on.
Yeah, it's definitely a differentiated service. It's not an us and them. It's not a contentious thing. We get that sometimes. People think it's like a contentious relationship. It's not by any means. We refer a lot of single family clients out to kind of retail agents and vice versa. It's just a different mindset and a different perspective on real estate. Yeah.
That's it. Great. So, all right. So at this point, you got your 5 unit, you moved to Florida, you came back. I assume you collected some more real estate, I believe, and now you're doing some syndications. Can you give us, what you did from then to now and what you're currently up to?
Yeah. So we started, like I mentioned, we started, relatively small. We got the house hack, the owner occupied property. And then we really kind of said, I actually got my license and didn't intend to, I got my license for somewhat selfish reasons. And then the more I got involved with the local real estate investment network in Boston, and specifically with the Canada Realty team, I said, oh man, I really love this. I'm going to be doing this every day anyway, walking properties, looking at properties. I might as well help other people. So I got my license. I got really involved in the Canada Realty team, met a lot of the team through some local real estate meetups that John had started. He started them in Lowell, like this was now back in 2018 or early 19. Those have grown substantially. So as I got involved with that group, more opportunity came about. And I can't stress that enough. This is a team sport. John and I talk about it all the time. I know, Matt, we've talked about it, but you can't take a selfish or individual mindset to this sport. You can do okay, but this really, having an abundance mentality, a team mindset, really can open doors that you didn't even know existed. So, fast forward 3 years later, we're at, myself, I have an interest or own 475 units, a little over that actually. So we've grown substantially, and we did that through partnerships, and we did that through having that abundance mindset. So we got involved very quickly. We got involved in a property in Lowell. It was 132 units, owned by the same owner since it was built in the late 70s. We said, how the heck are we going to buy this $20 million building? I don't know. Let's figure it out. So 4 of us came together, figured out what we needed to make it happen, made some phone calls to folks in our network and said, how are we going to do this? And they said, this is what you're going to do. It's going to be hard, but if you want it bad enough, you can go do it. So make a long story short, we raised just about $5 million from investors, friends, family, coworkers, etc. We bought this building with a clear value add plan. Update units, add technology, improve and add efficiency to the way the property was run. And just over a year after we bought it and had implemented this strategy, we received an unsolicited offer for substantially more than we bought it. We ended up selling the property about 13 months after we closed on it and returned a sizable profit to our investors. And so that kind of got that wet the whistle, so to speak. Our investors were happy. We were happy. We had gained some experience as operators, and we've just been growing the portfolios and the syndication projects ever since. So it's been fun. And as I say to most folks, it's scary when you get started. The first time you do something new, it's scary as hell. But once you take that step, especially if you're surrounded by a strong network, you'll be okay. And you'll have resources available to you.
And Todd, today you guys are operating across several different states. I mean, it's become much bigger than just this local area. You guys have definitely expanded. And talk a little bit about the mindset behind that. I mean, because it's easy to become sort of stuck into this mindset that like, hey, listen, this is all I can take on. We can only do a small amount of work, to now like, hey, listen, we're going to tackle 120 unit buildings and so forth and continue to go way beyond that.
Yeah, my mindset is everything. And as much as that, you can still get that imposter syndrome. This is for somebody else. So I'll tell you a quick story about that Lowell building, right? So we COVID had started. We had to shift our real estate investment meetups to virtual, right? We couldn't meet in person. And we had a guest speaker come and presented on large commercial financing for large apartment buildings. And he gives us this presentation, and it's how do you access low down payment loans, Fannie and Freddie loans, these really, really attractive loan products for like $10+ million assets. We're like, wow, we didn't know that was a thing. So after we got so jazzed up about this presentation, the very next day, a few of us had a call and said, why aren't we doing this? And we went around the group and everybody kind of shared their thoughts. And what we realized was because we were afraid, right? We thought it was for somebody else. There was no good reason. Nobody could come up with a single reason why we weren't doing it other than we were afraid. So we said, well, that's not a good enough reason. So it was that week of that presentation. We set out with a clear mission of what we were looking for, what type of asset. We didn't know what we were doing, but we had a clear mission. And so we went and attacked that mission. And sure enough, within 12 months, we had that first asset. But it is mindset. It is, and you have to reflect on that, both individually and with the people around you, and make sure that you're not falling into that imposter syndrome or it's for somebody else kind of attitude. Unless, of course, again, growth is not, growth for the sake of growth is not a good reason, right? But if you really kind of take a step back and think about your why and think about your goals, if you want to do bigger things, if you want to take on new challenges, if you want to do things you've never done before, then having that mindset is everything.
Isn't it amazing? So what's that phrase? Sophistication is simplicity, right? It's, if you think about it, you guys sat around and it was awareness that, all right, this is what we're feeling. We're feeling fear here. In all honesty, it's really just a limiting belief, right?
Yep.
All right. We're imposing this on ourselves. And so all you really need to be successful, I mean, you need a lot, but if you think about it, is awareness on your own thoughts, how to change them, and then a clear path forward, which you guys had, and I mean, how long, what was from that meeting to the closing of that 130 unit? What was the time frame on that?
That was so we had, that meeting was in that presentation, I believe, was in May of 2020. We closed, we had the property under agreement in August of that same year. So within 6 months.
Yep.
For a lot of reasons that we probably don't have time for today, it took almost a year to close it. So we didn't close until June of the following year. But we were really proud. We had that first asset under agreement within a number of months. There were a number of headwinds that we had to overcome with the seller, with COVID, with lender changes. And you know what? Every step along the way, it was like curveball gets thrown at you. All right, What there was no as many times as we were like, wow, this is really hard. There was no like thinking of going backwards. It was presented with a challenge, figure out how to address the challenge. And and we got phone calls after we closed this property because this had been marketed on, off market, etc. We got phone calls and said, how did a bunch of newbies close this property? Big firms had looked at this property. And we believe, we had a postmortem on this, we believe it was that attitude. It was, learn a piece of data that was a challenge, figure it out, renegotiate, ask for something, decide where we were willing to take risk versus not take risk. But every step along the way, it wasn't like, oh, well, like we're going to let the deal go. It was hell or high water. We were moving forward. We liked the deal. We knew how much upside there was. Figure it out.
That's amazing. And so do you think the bigger firms looking at this deal that passed, you think they weren't able to raise, or do you think their underwriting was not showing them something that your guys' underwriting was?
I don't think it was financial. I think it was mindset. I think it was, this is hard. The seller was particular. I'm not going to, speak out of turn, but seller was particularly difficult. These firms don't need to deal with that. They have enough deal flow. They've done deals before. I don't think it was worth the effort and time of their teams, or they didn't have, maybe they had so much bureaucracy because they're larger firms. They didn't know how to navigate some of these challenges, where with us, it was like 4 guys on a Zoom call or in a room. And we're like, well, I don't know, just let's do that. And then 24 hours later, that's what we were doing. So we had this like weird flexibility and urgency that really, really helped us. And we saw that because as soon as we closed, we got those accolades, and then we got the offer. And it was like, you guys basically earned your upside by closing this building, right? You've closed the building. You actually have like actual, P&L statements and general ledgers, and like you have financials for the building, not like we were getting them on napkins. I kid you not. We were getting rent rolls like on sheets of paper and napkins.
Mm-hmm.
So like by adding that process and eliminating the difficulty of an emotional seller, we had essentially earned our profit that day one.
And less ego, I bet, right? I bet those big firms have more of an ego. I mean, I have a strong feeling, me and Matt, smaller deal, but a 13 unit. And I'm sure it was a similar gentleman, an old salty Massachusetts guy, and there was several times Matt would call me, he wants this. It's, what's it going to cost? All right, just give it to him. Let's keep moving forward, right?
Sure.
Nothing that would kill the deal, but maybe some of the people, they get a bigger firm, they got more of an ego and they dig their heels in, right?
You're 100% right with that, Anthony, because I just remember going through some of this process, and it was like, well, this is how we always do it. No, we're not doing it that way. We're doing it his way. It's kind of like, all right, but we're going to trip over pennies to pick, to miss dollars, right? So we said, let's keep going. The deal makes sense. There's a ton of upside here. And that's what we did. And Todd, that's clearly what you guys did. One of the things I'm reading between the lines here, you guys sat down as a group of 3 or 4 of you guys, or however many there were, and you created a clear mission, right? This is what we're going to achieve. You wrote it down. You got specific on it. You set SMART goals. You went after those goals. Within 5 months, you guys had a deal under contract that, 6 months earlier, there's no way you would have dreamed of having a deal.
No.
But it was because of that mindset shift. It was because you wrote down goals, and it was because you took action on those. And I'm sure that you guys were reading those constantly to get to where you were. And then to take that, you think about the upside that created in your life. What a win that was when you sold it a year later. That's life-changing kind of returns that you're generating for others and for yourself. And that's huge.
Yeah, go ahead.
Any sense of how that compared relative to the market during that time? Were you 3x, 5x? What did that look like?
As far as return?
Yeah.
So we bought it with credits. Our net purchase price was about $19.2 million. We sold it for essentially 26, minus some closing costs. So our return was about 89% for our LPs.
Unbelievable.
In 13 months. So, and again, that's not how every deal is going to work out, but it's why you describe these sellers, these, longtime sellers. we have come to love them. They're typically really, really down to earth people. They just have they're just, they're selling legacy assets, right? They're selling something that means a lot to them and their family, and they don't want some Joe Schmo coming in and doing something dumb with it, or kicking tires. So we've really built our relationship on being a buying group that is flexible, that understands where the seller is coming from. And going back to why you guys asked about the bigger firms, they're coming in, it's all mathematics. And for us, it's mathematics too, right? But we're also coming in and bringing the emotional element, and not the emotional element in that we're going to be frictional, emotional in the sense that we understand what you're going through, right? We've done this before. We've purchased from, we understand this is an important asset for you, and the sale of this asset is going to change your family's life for the most part, because you're going to have this huge windfall. And we lean into that, and we think about how we can add value to the seller, not just us. And that has allowed us to I think, grow and buy and find and buy these assets, and ultimately create a reputation as a buyer group that will close on deals that we put under agreement. We don't lose deals. So it's been a great journey. And obviously the market, there's some headwinds, but if you buy right, if you buy with day one equity and you buy value add properties, you can do pretty well.
That's great, Todd. So what's the next? Obviously, I'm sure you guys have sat down again and have another game plan. What's the next 1 to 3 to 5 years for you guys? What's your next goal?
Yeah, we're just trying to do more of what we're doing. So since that project, we've closed 5 additional project funds. We do project specific funds, so we don't do blind pools. We won't do a blind raise. And for your listeners, what that means is we don't raise money first and then go buy an asset. We identify the asset. We use our money to lock the asset up, do our due diligence, et cetera. Only then do we open that for investment to our investment network. So we're doing a lot, especially in this market kind of cycle where deal flow is slow. Good deals are hard to come by. We're focused a lot on increasing investor awareness. We're spending a lot of time on the phone and via emails with our investors, getting better at underwriting deals, making sure that our existing deals are operating really, really well right now. So this is a really good building phase for us, where we've added hundreds of units to our portfolio. We've stood up a property management company, general contracting company to help support these properties. But it's been a really, really good growth phase for us, where we've been forced to make sure our processes are working well. And so that when we enter the next growth phase within real estate, we're going to be really prepared to make that jump from 500 units to 1,500 or 2,000 units, and continue to bring those deals to our investors. So we love value add. We don't buy turnkey assets. We buy properties that need roofs and renovations and difficult tenant issues. We've become very good at that. That's what we like, because that's where we think the equity can be added.
Yeah, you can truly force the value of a building up when you're solving problems, as opposed to just raising rent. And I think that's key, especially in this market. How are you guys feeling with interest rates and sort of some of the mortgages, the properties that are going to come out with perhaps upside down mortgages? Are you guys excited about the opportunity that you see coming in the next couple of years?
Yeah, we are. That's why we're being patient, right? So we made about a year and a half ago, we made a strategic shift that every single project we that we close has long-term fixed rate commercial debt. So we're doing 7-10 years fixed or longer, because the interest rate variability, we saw that coming. We saw the concern and the risks there. Now, do I know what interest rates are going to be in 7 or 10 years? I don't, but I don't want to worry about it. And I want to have time to reposition my asset for as long as humanly possible. We are having a lot of conversations with our investment network about variable rate commercial debt that is coming to either to maturity or for interest rate resets. And, I hate to say it, but I think a lot of operators that maybe bought peak assets or overpaid for assets or made deals work because they took on really short-term interest rate debt, variable rate debt. I think some of those guys are in trouble, and we're prepping our investors to be ready for that. where there's sentiment in our investor base that people are being cautious, people are stacking cash. There's a lot of liquidity out there, but folks are cautious in deploying that liquidity, and we think that's a good thing. We think that there's going to be improved opportunities to come in and buy these deals for well below market value. And that's just the normal nature of there's winners and losers, and we're trying to just make sure we're on the winning side of the equation.
Yeah, this is there's a market cycle here, and you guys are following the market cycle and following it by the playbook, right? And there are folks that didn't read the rule book to say, hey, listen, this is what we need to do when interest rates are low, and this is how we need to think about them for the longer term. So there's a lot of people out there that did overbuy, paid too much, that unfortunately will end up losing. And you get a chance to rescue some of these people, because some of these folks can lose their houses, they can lose everything they own. And you could come in as sort of a savior. Sure, they're going to take a haircut, but I mean, that's part of the process, and it's not a bad thing. I don't think we should look at it and frown upon it. We shouldn't try to be in those positions, right? And that's what we surround ourselves with experts, and we truly try to keep an open eye and underwrite conservatively on all of our deals. I think that's a big piece of this.
If I can add on one more important thing, and I think the audience, I think probably a lot of folks know this, but if not, leaning in, one of the things we're doing now, I was talking about building our teams, our processes. One thing we're doing now as well is we are really focused on our lender relationships. So when you get into the commercial space, it is relationship-based lending and relationship-based banking. A lot of lenders are in tough spots too, right? We saw with some of the banking stress earlier this summer and spring. Deposits are down, not a lot of deals are getting done, so loans aren't being originated. And so we're leaning into our top lending relationships in Massachusetts, New Hampshire, Maine, et cetera. We're meeting with them for lunch or coffee, or hopping on phone calls, talking about what we're seeing for deals. We're not shying away from those relationships. They're our team members. They are our business partners, literally. And so if we want to understand, what do you guys need? Do you need deposits right now? We can move money into you. Are you looking to place, loans right now? If so, maybe we can refinance some short-term debt or some individual properties. Maybe we can move those into a portfolio loan. So we're leaning into those relationships, and it has been, we didn't know if that was going to be a good idea. It has been one of the best things that we could have done. It's been well received. They've been very flexible. Does it mean we always get what we're asking for? Absolutely not. But just the fact that we're asking our lenders what's important to them and what's in their best interest, and taking that into account, I think it already has helped us a lot. And I think it will continue to help us in spades as we kind of go forward in time.
I mean, it's very smart, sorry, Matt, to cut you off, but I mean, me and Matt Clue, we're always asking the bank, how can you serve me? Right. And you guys are asking the banks, how can we serve you?
And the piece that I think is so important here is most of our transactions that we do are with credit unions, the smaller banks. They're not with the Bank of Americas. They're not with the JP Morgan Chases. You can actually have a huge impact on the balance sheet of a small bank by moving $500,000 here or there, right? It truly makes a big deal. And I know those sound like crazy big numbers, but when you get into some of these deals, they are big numbers, and you do need reserves that are a couple $100,000, and that's normal. And so being able to work with a bank like that provides them with so much more liquidity that they can use to grow or strengthen their balance sheet. So that I'm glad you brought up that point. It's hugely important.
Yeah. Absolutely. Couldn't recommend it enough. And so many folks that are getting into this space, and I don't fault anybody, because I did the same exact thing, but I try to share my experience and say, treat your lenders like partners, true business partners. I see it all the time. I'm buying a property. You loop in your lender at the 11th hour, you shop them all against each other. You don't close the loop. You don't, even if you're not going to go with a lender, send them an email, thank them for their time. I'm sorry, I found a more competitive loan option, but I appreciate you taking the time to do this. So many people treat these folks like they're disposable, and then they wonder why a loan term gets changed on the last minute, or they don't close the loan, or especially when you get into commercial loans and these credit unions, it is relationship based, and I cannot stress that enough. So yeah, you hit the nail on the head, Matt.
Let's not forget about you brokers either. I mean, when I first got into this, I thought, oh, I don't really have to schmooze the brokers. They're here to schmooze me. And it was a quick education, realizing it's more important for me to schmooze the brokers than it is for them to schmooze me. I mean, you gotta do the same thing. Got to stay in contact with the brokers. Buy them lunch, buy them coffee, and this way, when a deal comes around, like Todd, I'm sure you don't pick favorites, but I'm sure you have your guys that can close. And when a deal comes your way, you make sure to call them first, right?
Yeah, it's it's the nature of brokering anything, business sales, real estate, etc. You earn trust with people in your sphere, right? Whether it's a lender, real estate agent, etc. And burning bridges is not advisable. We don't sign exclusive agreements. But you're right. I mean, when you build a reputation, and there's guys that are going to get a phone call, or there's folks that are going to get a phone call, certainly, before things go out, wide scale. So.
Gosh, this has been awesome. I mean,
class. This is amazing. This is a really good conversation.
Yeah. We only have 2 or 3 more hours to go, right?
Man. Well, I tell you
this all day.
I mean, I tell you, I have I always got we all do a group of young guys and gals that give us calls and ask questions. How do I get involved in real estate? How do I start? And I always give them some tips. I'm just going to sit on this podcast. I mean, going from, you starting off in Ohio with a much smaller down payment, but able to get in the game, and then go the 4-unit to 5-unit. Obviously that's a little, but even just to have a 4-unit, I mean, that makes such sense to go in and have that for now. You have a 5-unit that you'll have, maybe forever, but it really got you in the game because you were able to live in it for a bit and put a low down payment and save a ton of money. So, I mean, that's a great way to get started. So congrats.
And don't forget your push to become geographically free, time free. I mean, those are huge. Like a lot of us don't think about that element. We think about the financial element, and it's the whole thing. We need to think about how we use our time. How are we, can we travel when we want to travel? Where can we work from, and so forth. And sure, financial freedom is definitely very, very important, but all 3 of those factors are massive. So yeah, I love the fact that you're going through lifestyle by design.
Couldn't agree more. And I know we didn't really touch upon it, and I probably should have at the beginning, but that's actually what really shifted our focus down this path, was that we were looking for financial sovereignty. We were looking for geographic freedom. And guess what? Rental apartments don't care where you are. So especially if you build the teams and processes in place. I have my phone with me all the time, and my team knows how to get a hold of me. And when you start to release those chains of this is for somebody else, and I'm just going to be, I'm just going to work for the same company forever. And if that's what you want to do, do it. I didn't want to. I wanted to work for myself. I wanted to have control over my schedule, and that's what set me out on the real estate path. This is just grown through partnerships and through our network. But the reason we started was exactly what you said, Matt, which is financial sovereignty and geographic freedom.
That's it. You guys and your geographic freedom, I tell you, Matt and Todd, you guys traveling the world. I'm stuck here in Brooklyn. It's fine. So it's all good. No big deal.
Listen, this is coming from the guy who spent the entire summer up in upstate Maine and kept the Brooklyn house. Like, good for you, man. Like, you got some,
Okay. All right. So maybe you're right. Maybe you're right. But Tom, this has been awesome. Please, tell the guests how they can get a hold of you.
Yeah, guys. So thanks again for having me. Candor Realty is really the best way to find us. We have a heavy social media presence. And as I alluded to earlier, and this got me hooked big time, is we host free real estate meetups in Massachusetts and New Hampshire, and now actually Maine and Lewiston, Maine, or Waterville, Maine, excuse me. These are places you can come and meet 20, 30, 40 like-minded folks who are, some folks just getting started, some folks, really experienced, but there's no reason, if you're interested in real estate investing, not to pop into one of our meetups, say hello, ask questions, and hopefully it'll unlock, doors and opportunity for you that you didn't even think were possible. So yeah, I can't thank you guys enough for having me on, and it's been a pleasure.
Absolutely. And just so our guests can find you guys, so is that how do you spell? Is that Candor? You said, correct?
Candor, Candor, and our meetups are called Simplified Real Estate Investment Meetups. Find us on Facebook. That's the best place to go.
Amazing having you on.
Awesome. Thanks, guys.
Thank you for listening to The Money Tree Show. We hope to inspire you to achieve financial freedom. To see a sample real estate deal, head over to www.themoneytreeshow.com.